Welcome to Iron Financial. This is the explainer where we help you forge a much stronger portfolio. We stress test the market's absolute biggest movers, and we cut straight through the structural weakness to find out what's really holding these companies up. I'm your lead analyst, and today we're throwing the latest earnings print from defense and technology giant Booz Allen Hamilton right into the furnace. We're looking at their fiscal year 2026 fourth quarter and full year results. And look, let me tell you right out of the gate, this is a highly complex blueprint. We've got structural paradoxes, we have shifting foundations, and honestly, a market reaction that has left a lot of retail traders totally scratching their heads.
Yeah, and that's exactly why I'm here. I'm the market skeptic. I'm looking at this data, I'm looking at the stock price action, and things are just, they aren't lining up. Usually when a company reports their numbers, you expect the market to react somewhat logically. But what we saw with Booz Allen Hamilton, ticker symbol BAH, it kind of defies the conventional laws of market physics. So it's our job today to really figure out if this company is built on a rock-solid foundation or if there are cracks in the armor that the broader market is just starting to notice.
Exactly. So grab your hard hats, everybody. Let's dive right into the Booz Allen stress test.
Okay, let's just start with a burning question on literally every trader's mind right now. According to the coverage that came out right after the bell, Booz Allen Hamilton delivered an adjusted earnings per share of $1.78 for the fourth quarter. Now, if you look at Wall Street's estimates, analysts were projecting an EPS of just $1.34. I mean, that is an absolute demolition of expectations. They crushed it by 44 cents a share, and yet the stock took a major hit following the release. As an investor, you see an earnings beat of that magnitude, and you absolutely expect the stock to gap up, right? Not gap down. So what gives? Why did BAH take such a hit? Is this just weird market mechanics, or is there a structural flaw hidden deep inside this earnings report? It's a fantastic question, and frankly, it is the core of what we're analyzing today. When you look at that raw EPS number, it looks like a reinforced steel beam. It looks impenetrable. But you have to remember, the market isn't just looking at a single data point. The market is inspecting the entire building. The sell-off we saw was a reaction to the underlying composition of those earnings, their forward guidance, and some very real macroeconomic headwinds that the company is currently facing, which actually brings us perfectly to our first major structural issue.
Section 1. The Booz Allen Paradox.
Lead analyst, we really need to frame this conflicting financial data as what I'm calling the Booz Allen Paradox. We are dealing with a structural contradiction here that requires a deep dive into the underlying blueprint of their income statement. In financial modeling, strength in one area can sometimes completely mask a severe weakness in another. Think of it like having this beautifully finished, shiny roof on a house, but it's sitting on a crumbling foundation. The top layer looks great. That's your earnings per share. But when you drill down into the actual revenue generation and the operational metrics, the story gets incredibly complicated. To understand this paradox, we literally have to put their top line and their bottom line in the same vice and squeeze.
Market skeptic. And here is the exact contradiction that's making retail traders so nervous. On one side of the ledger, you've got adjusted diluted EPS growing by a massive 10.6% year over year in the fourth quarter. Great, right? But look directly at the other side of the ledger. Total revenue actually declined by 6.4%, dropping to $2.78 billion. They completely missed Wall Street's top-line expectations. For anyone trying to build a resilient portfolio, this is a massive, glaring red flag. How on earth is a company generating more bottom-line profit while bringing in significantly fewer top-line dollars? Because let's be real, you simply cannot cut your way to infinite growth over the long term.
You're absolutely right. You can't. And that is exactly why the market reacted the way it did. A top-line contraction of 6.4% in a major defense contractor is a heavy weight on the stock. But before we declare the whole structure compromised, we have to evaluate the backlog. Revenue tells us what happened in the past quarter, sure. But backlog? Backlog tells us what's sitting in the pipeline, ready to be built.
And this metric right here brilliantly illustrates the long-term strength of Booz Allen. Sitting right there in their fiscal year 2026 financial results is a record total backlog of $38.2 billion. That's a 3.1% increase year over year. In the world of government contracting, your backlog is your load-bearing foundation. It's the contracted revenue that has been formally awarded but just hasn't been billed yet. A $38.2 billion foundation means they have years of heavy lifting already secured on paper. So yeah, while the immediate quarterly revenue took a hit, the underlying ironwork of future business is actually expanding.
And to really reinforce that point, just look at their trailing 12-month book-to-bill ratio. It sits at a very healthy 1.1x. For anyone following along at home, a book-to-bill ratio over 1.0 means the company's forging new contracts and adding to their backlog faster than they're fulfilling old contracts and burning through it. At 1.1x over the trailing 12 months, Booz Allen is proving that demand across their portfolios remains structurally sound. They are bringing in $1.10 of new business for every single dollar they bill out. This is exactly the kind of kinetic momentum that long-term investors want to see.
Okay.
The foundation and the pipeline look solid on paper. I'll grant you that. But listen, a backlog is just potential energy. We need kinetic energy right now. We need cash coming through the door today. The backlog doesn't pay the bills if you can't convert it to revenue efficiently. So let's see how this actually builds into their current operational reality.
Section 2. Cracks in the top line.
Because when we actually inspect the top-line execution in the Q4 summary, the visual of this revenue contraction is stark. We're starting to see some serious structural weaknesses hidden right behind that flashy EPS beat. Just look at the drop on this chart, straight from their own earnings deck. Back in Q4 of fiscal 25, they were sitting at $2.974 billion in revenue. Fast forward to Q4 of fiscal 26, and that number drops to $2.783 billion. That is a massive loss of top-line momentum. We're talking about a 6.4% year-over-year decrease. And actually, if you strip out billable expenses and look purely at revenue ex billables, it's an even steeper 6.8% drop, down to $1.9 billion. This is not some tiny rounding error. This is a heavy chunk of change missing from the quarterly ledger.
And the management team admitted exactly why this is happening. The source documents list several severe structural headwinds. First, they are operating in a slowed procurement and funding environment. The government simply isn't pushing cash out the door fast enough right now. Second, and honestly this is the one that really worries me, decreased headcount. It was specifically highlighted that Booz Allen shrank its workforce after a difficult year.
Right, which is a major, major red flag for any consulting firm.
Exactly. For a consultancy and a technology contractor, your people literally are your product. If headcount is dropping, your billable capacity is dropping. That points to potential structural rot. Add in a decline in billable expenses and anticipated external factors driving down their civil business, and you've got an environment that is actively bleeding the company's momentum. How does a company survive when its primary growth engine is stalling out?
Section 3. The profitability armor.
Those are totally fair points about the top line. I'll give you that. But they only tell half the story. The top line is taking a hit from a slow government procurement cycle, which, let's be honest, is largely out of their control. But what is under their control is how they manage their internal structure. When the top line is under pressure, a fundamentally sound company doesn't just collapse, right? They reinforce the internal framework. Booz Allen proved in Q4 that their defensive armor and internal efficiencies are what really matter for building a resilient portfolio. They focused hard on what they could control: costs and margins. Let's walk through this blueprint row by row, because this right here is where the true strength of Booz Allen shines. Yes, revenue excluding billable expenses dropped by 6.8% from $2,046 million down to $1,906 million. That is a heavy impact, but look directly underneath it. Net income actually increased by 6.2%, going from $193 million up to $205 million. How do you pull a profit increase out of a severe revenue decline? You execute with ruthless efficiency. Their adjusted EBITDA margin on revenue expanded by 50 basis points, jumping from 10.6% to 11.1%. This brilliantly illustrates their disciplined cost management. They tighten the bolts, they manage the working capital, and they squeeze more profit out of every single dollar that managed to come through the door.
And that operational discipline translates directly into ironclad cash generation. For the full fiscal year 2026, Booz Allen generated $951 million in free cash flow, compared to $911 million the prior year. That is a massive pile of unencumbered cash. For anyone building a dividend portfolio or looking for downside protection, this is the metric you care about most. This is the heavy lifting that makes a stock durable in a tough macroeconomic environment. That free cash flow is exactly what enables them to declare a regular quarterly dividend of 59 cents per share. In fact, over the year, they returned $837 million to shareholders and executed $1.1 billion in total strategic capital deployment. When a company can bleed revenue but still shower investors with nearly $1 billion in cash returns and share buybacks, that's a testament to serious structural integrity.
Okay, I got to step in here and throw some cold water on this whole structural integrity narrative, because retail investors really need to understand exactly what they're buying into here. Yes, they manage costs well, but let's look at the actual raw drivers of that $1.78 adjusted EPS beat. The company's own financial disclosures admit that this double-digit EPS growth was driven heavily by factors completely outside of core operations. Just look at the data: lower income tax expense, a massive reduction in share count, and unrealized gains on venture investments. In fact, their fiscal 27 8 EPS bridge explicitly shows a 50-cent non-recurring R&D tax credit benefit and an 11-cent unrealized investment gain, artificially pumping up their fiscal 26 numbers. Strip those specific one-off items away, and their baseline adjusted EPS drops to
$5.90. This isn't just operational strength, guys. This is heavy financial engineering. They bought back shares to reduce the denominator and caught a highly favorable tax break to pump the numerator. You simply can't run that play every single quarter.
Section 4. The Forward Blueprint.
Financial engineering or not, cash is cash and earnings are earnings. But I will concede your point. You really can't rely on non-recurring tax benefits to carry you forever, which means we have to look ahead. We need to analyze their guidance to see if this foundation will hold up over the next 12 months without the benefit of one-off tax credits and with a significantly leaner headcount. The past is the past. The market trades on the future. If we look at management's actual projections for fiscal 2027, they anticipate revenue between $11.2 billion and $11.7 billion. They're expecting to maintain that highly disciplined adjusted EBITDA margin at approximately 11%, resulting in a solid $1,240 to $1,290 million in adjusted EBITDA. Adjusted diluted EPS is forecasted between $6 and $6.35, which, as you noted, reflects the reality of not having that 50-cent tax credit from this year carrying over. Finally, they project free cash flow of $825 to $925 million. This is a very measured, highly calculated blueprint for the year ahead, assuming an average diluted share count between 118 and 120 million shares. It's not explosive for sure, but it is structurally sound.
And management remains highly confident in this trajectory. Chairman and CEO Horacio Rozanski put his official seal of structural integrity on the year, stating, "In a challenging year, Booz Allen delivered strong profitability while continuing to accelerate our transformation. We enter FY27 with momentum and are well-positioned for the year ahead. We're investing in proven growth areas and building tech to create long-term value for our shareholders and our nation." From the executive suite, the foundation is rock solid, and they are aggressively building upward.
Whoa, hold on. Let's cut through the corporate cheerleading for a second. Every CEO talks about transformation and long-term value. That is just standard operating procedure on an earnings call. The question we have to answer here on this explainer is simple. Is the momentum real or is it just hype? Because when I look at the hard numbers in that very same guidance, the specific numbers you literally just read out, the word momentum is the absolute last word that comes to my mind. If you're an investor looking for growth, let's look closely at their actual projected growth rate.
The crucial point is staring us right in the face, a 0% to 4.0% projected revenue growth for fiscal 2027. Wall Street was expecting $11.55 billion, and Booz Allen's range of $11.2 to $11.7 billion straddles that estimate, but it leans heavily toward flatlining. Best case scenario, they execute flawlessly and grow top-line revenue by 4%. Worst case scenario, 0% growth, completely flat. That is hardly an aggressive expansion. For a company supposedly entering FY27 with momentum and investing heavily in advanced AI and cyber technologies, a flat to 4% top-line projection keeps the stock grounded in a very, very harsh reality. And honestly, that is precisely why the stock dropped. The market looked right past the EPS beat, looked right past the tax credits, and saw a top-line growth engine that is genuinely struggling to turn over.
Section 5. Opportunity or Value Trap. I completely understand the market's hesitation, and that brings us to the most critical part of this whole explainer. We have aggressively stress-tested the financials. We've seen the impressive margin expansion and the massive cash flow. But we've also seen the shrinking headcount and the stagnant revenue projections. So what's the final read? Is Booz Allen Hamilton currently an opportunity for retail investors to forge a stronger portfolio at a discount? Or is this just a value trap waiting to collapse under its own heavy structural weight? To synthesize this for the viewer, we have to look at the internal market bifurcation they reported. On one side, you have the heavy lifting, their national security portfolio. Demand is absolutely accelerating here, driven by critical missions in advanced cyber, defense technologies, and AI-native products. Management explicitly stated that national security remains a strong, reliable growth vector. But on the other side, you have the deadweight, their civil business. They're anticipating significant declines driven by external factors, and they're still working through very challenging year-over-year comparisons in that space. The national security pillar is straining to hold up the entire structure, while the civil sector is actively dragging it down. That is a perfect summary of the tension. The $38 billion backlog heavily favors their defense and intelligence capabilities, which is exactly where the reliable government money sits. They've proven beyond a doubt that they can manage costs aggressively, protect their profit margins, and generate enough unencumbered cash to reward shareholders heavily through dividends and buybacks, even when revenue growth stalls out at 0 to 4%.
So the ultimate question for you, the focused investor constructing a resilient portfolio, is this.
Is this foundational strength, the 11% EBITDA margins, the massive $38 billion backlog, the near $1 billion in free cash flow, worth forging into your portfolio right now? Or are the top-line cracks, the shrinking workforce and the flat growth guidance, a trap waiting to collapse? You have to evaluate your own risk tolerance before buying this post-earnings dip. If you believe the government procurement cycle will unfreeze and their defense tech capabilities will surge, well, the foundation is ready. But if you fear further contraction in their civil business, you might want to stay on the sidelines. That wraps up our stress test of Booz Allen Hamilton. Keep your blueprints updated, stay disciplined, and we will see you on the next deep dive right here on Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.